What if I told you that there are 5 stocks with huge potential right now that most investors are sleeping on, and if you invested just $1,000 into them, you'll be a millionaire? That's the sort of irresponsible bullshit I hear YouTubers like Jeremy from Financial Education coming out and saying all the time, and I'm fucking done with it. Yes, I'm absolutely going to share 5 incredible stocks with you today that present a huge opportunity to make us a load of money, but I just can't stand what I keep hearing from this guy and other, and here's why. Guys, I hate what these YouTubers say. It's all clickbait. Why? They need this money to survive. They need to make videos to generate revenue to survive and make a living. So they will do whatever they need to say in order to get that. I said years ago that a lot of these YouTubers talking about finance, at some point when a bear market occurs, they will be wiped out and probably move on to some other thing out there that they can go sell. That's the way it works. Every other bull market in history and every other bubble in history, real estate, stocks, whatever, has a bunch of randoms that make a lot of money and then are wiped out. That's why I love bear markets. That's why I love recessions. But here are the 5 stocks that I really truly do love, but we got to make sure that they're at the right price, because in our principle-driven investing, one of the most important pillars of it, a great story can become a bad investment if you pay the wrong price. Stock number 1, Google. Now, we're welcoming back to the show our good friend Mo, who's been focusing on his channel. Mo, what's going on, brother?
Not too much.
You own Google, right?
I do.
What'd you buy it at, like 140?
130, 135, somewhere in there.
Well, you're a lot smarter than me because I never pulled the trigger on it, but it's currently at 166 after hitting an all-time high just about 5 weeks ago of 208 per share. It is down 20% in the last 5 weeks, which is part of the Magnificent Seven, which is down a ton. But it's a true $2 trillion company with an amazing balance sheet. Guys, the difference between enterprise value and market cap is essentially their debt. There's practically none here, and they generate last year, $73 billion in free cash flow. The last 5 years, $62 billion a year in free cash flow. 5-year return on invested capital, almost 17%, 19% the last year. They can use this and increase it to show the power of their moat. High return on capital businesses deserve a premium. And guys, another thing I love, look at this. Their 25% 5-year profit margin is up to 29% last year.
That's a significant jump.
Yeah. For a company that's 58% gross margin, they can keep driving that profit margin up. Now, guys, that's only 1 year. Who knows what they did to get that? They could have cut expenses versus growing revenue. That's really important to look at. Let's go look at their 8 pillars to see what story that's telling us. Oh, Mo, what do we love here? Look at this. Do you see this? 8 pillars.
I'm assuming valuation metrics?
Valuation are the X's. Everything else is a check. But remember, just because there's an X there, it doesn't mean that it's a bad investment. Let's say Google was going to grow their profit 100% a year for the next 10 years. You would gladly pay 30 times earnings and 30 times free cash flow, wouldn't you?
Definitely.
That's the point. And a high moat business deserves a premium. The question is, how much of a premium? Now, Alphabet is the company that turned just Google it into a universal command. This isn't some one-trick pony. It's a tech empire that keeps finding new ways to dominate. First up, Google Cloud, a 35% revenue jump to $11.4 billion. Guys, that's significant, especially that it can grow, and the company does $350 billion a year. This is a part of the company that's in its infancy. That's something that could grow and add significant dollars at very high margins to the business. And then there's AI. Over 25% of new Google code is AI generated, making everything faster, smarter, and way more efficient. Their AI-powered search already engages over 1 billion users monthly. Good luck competing with that. Of course, there's Waymo, and there's talk about a partnership with Uber. Now remember, guys, we have a story. We have numbers. We have to put them together. Don't be that sucker investor who just focuses on the story. If you do that, you're going to make a lot of mistakes. You're going to lose a lot of money. You got to make sure that the right story becomes a great investment at the right price. That's why we use our stock analyzer tool. This tool allows us to make assumptions about the company, factoring the story, to then tell us what the right price is to pay based on our assumptions and our desired returns. Now, if you're in our community, you know that you can ask people for their advice and guidance. It's the most shared part of our software because it's used over 1 million times per year. So make sure if you're confused about what assumptions to make, get advice from people in the community. But the last time I did Google was probably the time when Mo bought it and he was brilliant for buying it. Not really. So Mo, look at these. First off, look at this ROIC. Last 10 years was 14.5. Last 5 years is 16.9. Last year, 19%. A growing return on capital. This means they're solidifying that moat status. Revenue growth. I did 4, 8, and 12%. What are your thoughts on that, Mo?
Mine is higher, but I can see why you did that.
What's yours at?
I did 7, 10, and 13.
Okay, 7, 10, and 13 for the next 10 years. I mean, that's very possible. That would be over doubling its revenue in the next 10 years. That's possible.
Yeah.
Margin.
Possible.
I did 22, 24, and 26. I actually feel like that could be higher. What'd you do?
I did 23, 26, 29.
Okay. PE, I did 20, 23, and 26 because, like I said, it deserves a premium to the market average of 15. What'd you do?
I did 21, 24, 27.
Desired return, I did 9%. Now remember, guys, this desired return has zero margin of safety in there. It's basically to come up with what's my intrinsic value of the business. I match the market. But remember, you need to have margin of safety because we're humans and we make mistakes and the future is unknown. So these are the assumptions I made. What do I think Google is worth, not including the balance sheet? Hit the analyze button. Well, look at this. I have a low price of 122, high price of 327, middle price of 201. So even at today's middle assumptions, I can get 11.5% return on Google. Guys, I remember when Google was 85 and I wanted to fall lower. Am I just waiting too long? I don't know. I have it on my watch list at 165, which is imminently going to hit here, Mo. It's because it's at 166. Doesn't mean I'm buying it, but I'll probably sell puts at lower prices to buy the company. Stock number 2, Ulta Beauty, a company that I own. And remember, Mo owns Google, I own Ulta. Don't buy a company just because somebody on the internet does it. We're here to teach a process. We're here to teach you how to fish. This principle-driven investing process you can take and apply to anything else you want. That way, if Mo and I get hit by a bus and our channel goes away, you still have the ability to go pick great companies. So, Ulta Beauty, down significantly from its all-time high just 1 year ago, March 14th, 575, hit a low in August of 318. It's currently at 346. $16 billion market cap business, higher returns on invested capital than Google, 21 and 27% over the last year. Incredible. Free cash flow, $1 billion, net income, 850, selling for 13 times earnings, 16 times free cash flow. Guys, I'm actually impressed with their enterprise value. Only $3 billion of essentially net debt. Now, Ulta is doing a great job of being smart about their growth, and that's what I love about it. Look at this, what I also love. Acquisitions, essentially $1 million, but essentially nothing. And look at this revenue growth. 3 years of 12% a year, 5 years of 9.5%, 10 years of 14% revenue growth. Now it's a combination of organic growth and opening new stores. So that's incredible for the company. Let's go check out their 8 pillars. Ooh, 8-pillar thriller.
Wow.
One of the things I do like about Ulta, they're buying back shares on very reasonable valuations with good growth potential. I want to see, what do analysts think about their revenue growth potential? Not much. Look at this, Mo. Basically inflation, 3, 5, 5, 5, 4.7. Not the growth they had in the last 5 or 10 years. Now, Ulta Beauty is a company that proves makeup and money can go hand in hand. All that money your wife spends and your girlfriend spends on makeup, go make something from it. In the third quarter of 2024, they pulled in $2.5 billion in sales, which surprisingly was a 1.7% increase. Not earth-shattering, but steady. Now, in the terms of growth, they plan on adding 200 new stores, pushing past 1,800 locations in 3 years. That is serious expansion. And I love the fact that it's not over-the-top expansion. Plus, they have over 44 million members in their loyalty program. That's a gold mine. And they're trying to get to 50 million by 2028. More loyal customers equals more predictable revenue. And tech is also on their radar. They have made digital investments aimed at personalized marketing and smoother operations. And let's not forget shareholders. Since 2014, they have returned $6 billion through buybacks with $3 billion more to come. That's huge, guys. If you buy back cheap stock, they're giving you as an investor a bigger share of the company by doing nothing. So what's the bottom line? I believe Ulta is playing the long game and playing it very well. Now, we saw their revenue growth potential here, but look at this earnings per share growth. 50% increase from $24 to $37 in the next 5 years. That's some pretty serious growth. That's 15% growth a year. Now, Mo, do me a favor. Mo's our trading expert here. Now, one of the great things about what we do in this channel, Mo has his own trading channel, but we used to talk about this all the time early on in our company, in our channel. But now we're going to kind of bring it back and look at the charts here. What are the charts saying about this? Because the great thing about charts is it doesn't care about the fundamentals. You can trade whatever, hell, if you want to trade Bitcoin, which has zero fundamentals, go for it. What are the charts saying about Ulta?
Yeah, so something I really like, if you kind of zoom the chart way back and you can kind of just draw this line across, you notice that this goes back to 2019. You had a little bit of consolidation here, meaning that the stock just sat there at one certain level. Then if you notice, the stock price went up, fell, and it just kept falling to that same level. You had big runs up, falls down, kind of that same level. And now we're at that level. So what does that tell me as somebody that reads charts? We're at a pretty strong base, meaning that if I was looking at this saying, okay, when's a good time to get into Ulta to buy it? Odds are that it's going to sit here at this base that I drew, about $350 a share, and it's probably going to start climbing up over time. It's very hard to break support levels like this that date back, especially 5-6 years. So this is a way that you can utilize charts to get into something long term. Is it going to work every time? No, it could easily come down to
and if it does,
right here.
I think if it breaks to that level, watch out, right?
Yeah, because this thing is going to fall. It's going to get to 300. It could go lower than that.
That would be awesome. And that's the thing. Like if you're a value buyer and you look at the charts and seeing like, hey, I'm happy not owning it at 350, but if it goes lower, I could easily pick it up for much lower prices. That's a great thing for buyers.
Exactly.
All right, so let's go pull up the stock analyzer tool and marry the story with the numbers. Let's pull up Ulta. The last time I did it. Now, guys, I did 2%, 4%, and 6% revenue growth for the next 10 years. I did profit margin of 9.5%, 10.25%, and 11. Same with free cash flow margin. PE, I did 15, 18, and 21. Went a little bit lower on PE, even though their ROIC is getting bigger. And I did a 9% desired return. I hit the analyze button. The stock's currently at 347. Look at this, Mo. I have a low price of 327, a high price of 630, a middle price of 455. If I paid today's price,
this is interesting.
I'm looking at about a 12.9% discounted cash flow return. And if they ever pay a dividend, because I don't think they do, that would include the dividend payment. So this is looking like, 12.9%, not bad for a company of the size that's buying back a lot of shares and still has growth potential in its earnings. I kind of like that. I think the potential is better than that, but we'll see. As time goes on, this is exactly why we invest, but you have to be a long-term investor. Who knows what the short-term, this stock could go to 200, 150. Stock number 3, ASML Holdings. Guys, this company, $269 billion market cap, $288 billion enterprise value. Not much debt there. And this company generates almost $10 billion last year in free cash flow, $7 billion over the last 5 years. And I love the fact that their free cash flow is higher than their net income. Mo, return on invested capital, a consistent 26 to 27%. Barely any acquisitions, total 5-year net acquisitions of $80 million. And look at these growth rates. Revenue growth of 15% in the last 3 years annually, 19% annually in the last 5, 17% annually in the last 10 years. This company is killing it. They pay about a 1% dividend, about $2.7 billion, about 27% of their free cash flow. That's a lot to absorb. The biggest numbers here are price to free cash flow is 27, PE is 32. All right, so big company, kind of selling for a lot in terms of a metric, in terms of earnings and free cash flow. But let's see what the 8 pillars show us. Just like Google, you're just waiting for the valuation metrics. Didn't buy back a ton of share, but the revenue growth, this is what I like, Mo. $18 billion in revenue growth, $7.3 billion in free cash flow growth versus $5.4 in net income. So they grew their free cash flow much faster than their net income. 51% gross margin. There's a lot of great things here, Mo. They have higher profit margin than Google with a lower gross margin. That's interesting. So they make less on every dollar of revenue than Google does, but they make more to the bottom line than Google does. That's pretty interesting. Now, in the fourth quarter of 2024, ASML reported net sales of 9.3 billion euros, a 24% increase from the previous quarter. 24%. And even better, a 32% increase in net income. The company also recorded net bookings of 7.1 billion euros, significantly surpassing analyst estimates of 4 billion. ASML's advanced EUV machines are indispensable for producing high-density chips, making the company a critical supplier to industry giants like TSMC, Taiwan Semiconductor, Intel, and Samsung. The surge in demand for AI processors has further amplified the need for their technology. Now, obviously, there's a lot of geopolitical challenges, including the US-led export restrictions affecting sales to China, but they're still maintaining their 2025 sales forecast of 30 to 35 billion euros, driven by robust demand for its EUV systems. So let's see what analysts think, if they agree with this. Earnings per share, Jesus, going from $26 to $50. Yeah. 25, 21, 20, 17, and 10% earnings per share growth. Revenue growth? Look at this, Mo. 16, 12%, 11%, 11%, 12% revenue growth. That's big time growth. Big time growth. Now, this is only 5 years, 4 and 5 years. So let's see what I did last time. I did 10-year assumptions. This is higher than I usually do. Now, remember, this is banking on AI and the fact that this will continue to grow like crazy. I did 8, 12, and 16% revenue growth. Now, here's the key. 1 year, though, I only did 2.5% revenue growth. That's kind of slow. Profit margin, I did it lower, 22, 24, and 26. So I think I got to up that a little bit. Let's sit there and say, let's go 23, 26, and 29. PE, I did 15, 18, and 21. I could probably go higher on that one as well. I could probably do 17, 20, and 23. And 9% desired return, hit the analyze button. The company is currently at 682. I have a low price of 435, high price of 1250, middle price of 745. Mo, is 10% desired return enough for you to pull the trigger on a company like this?
No.
Neither. Same thing for me. Now, this is an interesting company.
I'd rather buy an ETF.
Right. So I look at this going, okay, let me do 12% return across the board. The middle price is 590. So I'm going to add it to my watch list at 600 because I want to sit there and start selling puts on it at this price and take a look at it again. Stock number 4, TDW, Tidewater. They're involved in the energy industry, operation of a diversified fleet of marine service vessels. This is something that our good friend Dalton loves so much. $2.2 billion market cap, much smaller company. Return on invested capital, 11.7%. Last year, 2.3% over the last 5 years. Profit margin growth. This is a tough one. Look at this growth rate. Well, they spent a lot of money on acquisitions, $615 million in acquisitions in the last 5 years. That's why they have major growth rates in their revenue. So that's something to consider here. Not a ton of debt. $2.8 billion enterprise value versus 2.15 market cap. Selling for 8.7 times free cash flow, though, Mo. That's pretty low. But look at their free cash flow last year versus last 5 years. Is this a company that needs to be looked at over long periods of time? Where's the stock currently at? $40 a share, all-time high, just last year of $111 per share. $111 per share. Got as low as $38 just last week. That's incredible. That's a 65% drop in the last, 60% drop in the last year. Incredible. Let's look at their 8 pillars. Oh, 5 X's, 3 checks. Look at that. Yeah. Oh, so this is what the reason is. The debt's an X because of how low their free cash flow was in the last 5 years. Guys, this is really important that if you want to understand this company, go into the community, talk to Dalton. He understands this stuff a lot better, but please don't buy a company like this unless you understand it. I can already tell it's going to be one of those companies that has a lot of inconsistent results. This is a company that lost money until recently. Look at this, Mo. Losses all along the way. Jeez, oh, Pete. Oh. Understand why it's making money today. Here's what's getting my attention, though. Insider buying. The CEO, Quentin Kneen, put $2 million of his own money into the stock. And director Robert Robotti followed with $1.1 million. When insiders are buying, they're not doing it for fun. It means they're buying to make money. That's the only reason people buy an investment. Tidewater dominates the offshore support vessel space, serving oil, gas, and now offshore wind. That diversification is a smart long-term play. So let's go check out the analyst estimates on this company. Not much out there, but look at this big jump. 40% increase this year in earnings per share, 75% next year to $9.19 per share. Guys, if this is times 15 only, you're at $165 a share in terms of earnings per share. Nope, Sorry. If this is 15 times share earnings multiple, you're looking at $135. That's an all-time high for the company. The question is, what is causing them to think? These are a lot of analysts, 9 and 8 analysts thinking $9 per share. And the range is $6.40 to $11.91. So the range is very, very high. That's what's incredible. Revenue growth, 7 and 15%. Again, a lot of growth there. Now, guys, for this company, the stock analysis is going to be very difficult unless you really understand the business. I don't understand the business very well. I'm not going to do that. But Mo, the chart looks really freaking nuts here. Look at this chart here for the company. What are you seeing?
So it's crazy, but if you look at it in this way, again, it's almost the same as Ulta. You have this base that was created back here in 2023. You're kind of there. So this is a strong support level. Does it mean it can't go below it? No, it can. But realistically, this can probably get down to 35, 30, maybe 25, even 20. Who knows how low this can go? But these are the ways that I look at saying, okay, I own this. Let's say I want to buy it lower. Well, I'm going to look to be buying around 35. Next number's 30. Next number's 25, et cetera. So that's kind of how I can use this when buying stocks for a value position for something long term.
All right. Again, guys, the great thing about trading is with charts, it doesn't matter about the fundamentals. You can sit there and trade it using just the price movement. You don't have to care. But if you're trying to buy based on fundamentals, you can see where support levels are, because if you don't need to buy the stock, or you can wait for a lower price, see if it breaks through there. That's the big thing here. Now, again, doesn't mean you should, it's whatever works for you. Now, from the fundamentals perspective, let me ask you something. How confident are you when you make these investing decisions? Do you truly understand the companies you're buying, or are you just following stock tips? This TDW, for example, two guys I really respect own the stock. I do not. I know what it feels like to invest without a real process, because I've been there. Early in my investing journey, I bought a stock called Global Crossing. It was told to me by my sister's boyfriend's father, this is going to be the next big thing. The CEO became a billionaire faster than anybody in history at that time, and I bought it. Guess what? It went to zero. I did zero research. I didn't have a process. I had no community to challenge my thinking. When the stock went to zero, I lost it all. It was painful, but a necessary lesson. That lesson is, if you don't know what you're doing, if you don't know what you're buying, the market will humble you fast. Our third pillar in our principle-driven investing is, if we don't understand it, we don't buy it. And this is exactly why Everything Money was built. I did it to teach people. I want to teach people how to fish. But the way I do things is not exactly the way you should do things. You need to sit there and take the fundamentals that I say, the baseline of what I say, and apply it to the things that you know and understand. We also have all these tools that help us make great investing decisions. And now thousands of investors use it every single day to help them avoid the mistakes I made early on. Right now on everythingmoney.com, we have a wait list. But here's the deal. On April 15th, we're making major changes. The changes we've been talking about for a while. This current offer will be gone forever. If you join before then, you'll be grandfathered in for life to be able to take advantage of all the tools and the best offer we've ever made. You'll be locked into your pricing tier forever, and you'll get unlimited access to all of our investing tools, all of our real estate calculators, and most importantly, our community of several thousand like-minded investors who help each other every single day. We recently had a big red day, several actually. The community in here was cheering and excited about it. And the best part is, in just a few minutes, you can have access to the software. You can start analyzing stocks, researching real estate, and planning your financial future. But guys, and this is most important, if you want to learn how to fish, if you want to learn how to become a better investor, this is the place for you. If you want to just be told what to buy, go to those other idiots out there on their financial YouTube channels that are just giving you bullshit stocks to buy with no fundamentals behind them. If you want to continue how smart you are by watching this video this far along, go join the community. I assure you, it'll be the best decision you've ever made. Stock number 5, Rowe Price, a company that I currently own. And again, don't buy it just because I do. This is a money manager, manages trillions of dollars. Look at how much the stock has fallen. All-time high, August 30th of 2021 at $224. 52-week low of $97 just happened a couple days ago, but it got as low as $87 back in October of 2023. Guys, look at this dividend yield, 5%, but it eats up a huge chunk of their free cash flow. And guys, as the market goes down, this company will suffer along with it. But I believe in their management, in the sense of what they're trying to do. They literally provide great services for people for financials, 401ks, things like that. Great profit margin here. Gross margin of 52%, bottom line of around 30%. They pay a huge dividend, but look at this PE, 10 times PE, 17 times free cash flow. And look at their free cash flow last year, significantly lower than their net income, but in the last 5 years, if you take out last year, they're pretty similar. Now guys, this is not for the faint of heart, because when the market falls, this company will fall along with it. So let's check out their 8 pillars here. Okay, a little bit different, 2 X's, but net income and free cash flow. Those are the ones that have fallen. Look at this debt level, Mo. Their debt level is nothing. They actually have a lower enterprise value than market cap. That means essentially their net debt with cash on hand. How do you go bankrupt when you have more cash on hand than debt? You can't.
It's hard.
Right? Let's check out the analyst estimates here. Even with the market where it's at, a little bit of growth, not a ton. And look at this revenue, choppy along the way. I don't blame them, because I do think the next 5-10 years are going to be choppy for this company. The question is, can you buy it at the right price? Mo, from a trading perspective, please look at this one, because I really want to understand this and what you see as support levels going forward.
So I think we're currently at a support level. Now, what's interesting is you can kind of see, so I'm going to draw this line on the bottom, but you can kind of see this line on the top. You see how the stock price bounced up to it. So this is what we call a consolidation channel. And you can tell, outside of this big jump that happened, the stock has not moved out of this channel. So you can pretty confidently buy anytime in here when you get to this top part. So for me as a trader, looking at this saying, all right, when this gets around 130, I'm going to exit the position. If I'm going short, if we're around now about 100, I'm going to exit the position. I'm going to switch it to go the other direction. So that's how you can look at it from a trading perspective, but also know if you buy this long term, don't get frustrated if it hits 130 and it just doesn't break through and it goes back down. You have to be patient.
Now, Mo, what's those lower lines, the stochastics?
These down here?
Yeah. What's that showing you?
This tells you the current trend that is happening. So right now, this is a downtrend. Obviously, that coincides with the stock price falling down. Usually when the stock price long term is going up week after week after week, you have a positive trend. So Paul, I want to mention my trading channel. So I have a trading channel that is completely specified to trading and learning how to trade the way that I do. The link is in the description below. Click it. Come over, guys. Check it out. It's a really fun, different way. And it's another great way to, instead of saying buying Rowe Price, say you're getting excited, you just want to participate. This is a good way to stay active and maybe deploy a little bit of capital, have some fun without going and making a financial mistake or doing something crazy that you wouldn't normally do just because you're bored.
Yeah, I mean, that's a big thing in investing, is making sure you keep yourself active so you don't make bad investing decisions. Keep yourself active in other areas. Now, for Rowe, I did a 20-year analysis because this is a company that I'm looking at from a long-term perspective, okay? I did 3, 5, and 7% revenue growth. I did profit margin of 26, 30, and 34, free cash flow of 22, 26, and 30. And then my PE and price to free cash flow, I did 15, 17, and 19, and my 9% desired return. I hit the analyze button. Guys, the stock's currently at 97. I have a low price of 113 to 133, a high price of 277 to 313, a middle price of 177 to 204. This current price return includes the dividend. And guys, this is a 20-year analysis. This is not for the faint of heart. Now, guys, you just saw us break down 5 potential multi-bagger stocks. But if you think watching one video is enough to master that skill of finding great companies, think again. Because real wealth in the stock market isn't built by copying picks. It's built by understanding why a company has the potential upside versus the price it's selling for before the rest of the world catches on. If you want to consistently spot undervalued stocks with explosive potential, you need to develop the right mindset, the right process, and more importantly, the proper emotional state. And that's exactly what you get in our next video. So click the video linked on the screen to level up your investing skills and start thinking like a principle-driven investor. Thank you for your time.